I've been a landlord. I am a landlord right now, and it's a bit of a headache. Interest you pay to the mortgage, property taxes, maintenance, repair, time you put in, right? Issues related to tenants.
And these are all costs that have gone up exponentially in the past 4 years. The rental income goes down as well. Rents are declining now. I have heard of tenants not paying for 6 months, eventually getting evicted, but then for whatever reason, not having to pay the 6 months.
Very hard to collect it. Well, listen, when you're getting yields of 8, 9, and you can get it every single year, it's tough to beat long term.
Welcome to episode 4 of The Wealthy Lender. I'm here with Chris Nichilo, founder of Magnetic Capital Group. And today we'll be talking about why being a landlord in Ontario isn't appealing anymore.
I don't know if I'd say it's not appealing. I think there's just a better option, you can, because there's lots of landlords out there and they're all I'm sure most of them do a great job, and it's not easy. And it can be very rewarding, obviously, with when things are really good and properties are appreciating at breakneck speed and so on. But again, back to, we've talked to so many times, it's like the tortoise and the hare. When you look at buying the real estate, there are some advantages for sure. You can leverage your money, right? You can put 20% down and get 100% of the asset. And if you buy in the right places, appreciation can help you and so on. But what people tend to forget when looking at things from an investment perspective is long-term, by the way, like long-term, doing this when you're young, buying the property, being a landlord when you're young and holding it for 25 years and letting the renters pay the mortgage off. Okay, totally get it. Great investment. But it's important to consider simplicity. And I would say owning the real estate and being a landlord is much more involved than being a lender. Not only having to deal with maintenance and upkeep of the property, but management of the tenant. I've been a landlord. I am a landlord right now, and it's a bit of a headache.
Oh, you are a landlord. I didn't know that.
I am a landlord. Yeah. I did not become a landlord for investment purposes. I bought a place and then moved to a new place and didn't sell the old place, so I ended up renting it.
Gotcha.
But it's been good to have the experience of being a landlord. Now, what it's taught me is to every scenario is going to be different. There's going to be some real winners out there to be a landlord, but you got to consider interest you pay to the mortgage, property taxes, maintenance, repair, time you put in, right? Issues related to tenants that can cause, losses or, a lack of consistency with the rent, or become more problematic, right? In the worst case scenario where you have a tenant that's a real problem and, it becomes a bit of a nightmare. So there's some risks there that you don't have in the private mortgage space. What we see is a lot of people who were landlords for a long time, as they get older and don't want those challenges or headaches to deal with anymore, they sell the real estate and lend money to younger landlords. And it makes a lot of sense. So it's not to say you can't be a landlord and be successful or any of that. There's a time and a place and a way to do it that works. But there's another option. So if you're not a person who is comfortable taking on being a landlord, you can invest in the real estate a different way, right? You can be the bank instead of the landlord. And there's a reason why I think banks lend money instead of owning the property. They could own the property, right? I mean, they're wealthy enough.
They don't want the keys, though.
No. And if you think about the relationship there, okay, and you were to take all emotion and everything out. And I said to you, well, there's going to be two partners in this venture. One is going to bring 80% of the money to the table. The other is going to bring 20% of the money to the table. But in exchange, the one who brings 20% has to do 100% of the management of the property and the tenant, and is responsible for 100% of the upkeep costs, and is also going to pay interest to his partner or her partner who brought the 80% of the money to the table. It tells you what's more valuable, time or
Yes.
money,
Right.
right? So you get to choose. Do you want to be the person who brought the money to the table, sit back, collect a payment every month? Anything goes wrong, not your problem? Or do you want to be the person who only brings 20% of the money to the table? Good perk, but has 100% of the other risks, the headaches
Yeah.
and all the rest of it. Which
For,
do you choose?
from what I understand, and you can probably actually speak to this since you're in the game, or I'm sure you know other landlords. Um, Either you have enough doors where you're able to justify paying for property management,
Mm-hmm.
or you got to be a real handyman because you're going to be doing a lot of stuff yourself because you don't want to pay out contractors and lose all your yield. Or and I've heard this on the Bigger Pockets podcast, which is the biggest real estate podcast in the States. But the way they do it down there is that 1% of the property value is what you should be collecting in rent every month. And there's no way we're doing that in Canada. So the owners kind of like rely on appreciation in conjunction with the rental income they're getting. So it's like one of those three. Um, is that accurate
Yeah.
in your experience in Canada, or?
Yeah, I think so. I mean, I think it can be difficult to achieve cash flow positive
Yeah, without
as a
appreciation.
landlord without appreciation, and especially um, when you factor in, you know, all the different costs. I mean, it's difficult to be cash flow positive. If you are, you're doing great. Now, if you factor in management costs on top of just everything else, it makes it even more difficult to cash flow. So that it it just is. But you are building equity, right? So in private lending, you have the equity, you lend the equity and you make a monthly payment, but you're not building, your equity isn't growing. You're just collecting interest. And if you save the interest, then you're building. But other than that, it's different.
Yeah, you're foregoing upside and you're not building equity. So those, I guess, are the two biggest things.
Yeah, you buy the real estate, you have the opportunity for it to appreciate on you in terms of, and then you're getting benefits on both sides. The value is going up, the mortgage is coming down.
Hmm.
You're creating a bigger gap every year, right? And
Yeah.
if you can get it so that it's cash flow positive and the renters are paying all the expenses, not just, the mortgage. Yeah, you see this a lot where people think cash flow positive is the property or the rent covers the mortgage, but it needs to cover a lot more than the mortgage, right? It
Oh yeah.
needs to cover the property taxes. It needs to cover the maintenance and the upkeep and the repairs and everything else.
And these are all costs that have gone up exponentially in the past 4 years.
Yeah, well, they do different things, right? Like houses appreciate, they depreciate. Interest rates go up, interest rates come down. So again, you're talking about a more volatile way to invest in the real estate than through the private mortgage or private lending side of things. There's just more volatility.
The rental income goes up and down as well. Rents are
True.
declining now.
True. Cost of goods, all the rest of it. Yeah.
Yeah.
So
It's
it's not better. It's not worse. It's not being a landlord is horrible. Can't be done well. It can be done very well. But you also don't forget to acquire each property gets difficult and more difficult to leverage, right? So to continue to get mortgages from traditional sources. And if you're not getting them from traditional sources, your cost of money goes up, which means it's even harder to cash flow.
how many borrowers have multiple properties where they're kind of like trying to pass on certain collateral over to you, and you're like, I mean, that's great. That triplex looks great, but I'm still only taking your house. Like, what's the reason behind that? What's the thought process behind that?
The thought process behind
Like, why would you want a borrower's detached house when they want to borrow against their triplex or something?
okay, well, first of all,
Because
I mean,
you've talked about this in the past, where
yeah, first of all, I mean, if the collateral is the roof over your head and your children's head, it's that much more powerful, right? It's that much more it's stronger. So the chances are you're really gonna focus on making that a priority, not only making regular payments, but also paying the mortgage back as soon as you can. So I mean, there's that. Now, I can make an argument the other way. You know, there are scenarios where I see a mortgage application and I'm happy that it's an income generating property. It actually gives me some comfort to know, especially if there are income or payment risks involved on the borrower side. So if I look at the borrower and I say, you know, this borrower, the income is tight. It's acceptable, but it's tight. Or the income type is self-employed, but she's only been self-employed or he's only been self-employed for a year. Who knows if it's, you know, I know what it's like to be in business for yourself and to start from scratch. It's not easy. So there's risk there. In those types of scenarios, I'm comforted by the fact that there's a tenant contributing to make it easier for this borrower to make payments to me.
right, makes sense.
However, without the tenant, default feels like an almost a certainty. So I have to be careful. What happens if the tenant, he can't rent it, she can't rent it, or the tenant leaves or stops paying? There's a dispute. All of a sudden, I'm in the middle of that too. So I got to be careful. But I'm saying I could make a case for rental. So I don't look at it and say one is better than the other. I think it's case by case. I think it's case by case. But there are different risks. There's different risks for both scenarios. Do I feel more comfortable lending against somebody's primary residence? I do. So I have like a legit reason for why. Not really, because I can kind of see the merits of a rental property in the right scenario. So
It sounds like, just broad strokes here, if you're very handy, if you like to, get in the weeds on stuff and get your hands dirty, versus if you were to do private mortgages yourself without the help of a syndicator, then it's more like on the underwriting side, kind of data crunching, comparing certain things, doing deep dives on data. Like those seem to be the two kind of profiles.
yeah, I mean, I think if you are a person who, and I think this happens a lot, is where people who do have those skills and feel like they can, like the do-it-yourselfers, you know, if you're a do-it-yourselfer, you can really make an attractive budget, on paper for what it's going to cost to acquire and manage a property with tenants. And if you're that person, you're probably not the person who's going to have a management company doing it. You're going to do everything yourself.
Yeah.
And for sure, you're going to save money. But it's in exchange for time. Let's not, right? You're going to put time in.
It's less passive at that point.
And if you count that on a balance sheet, are you paying yourself? And what are you paying yourself for your time? How many hours are you putting in every month, every quarter, every year? Right? So when we're looking at it as an investment, you'd have a line item for that. What's the time contribution? Because that's how you compare apples to apples. So again, not bad, just different. And for different, they say different strokes for different folks, right?
How much time are you spending underwriting and managing the loan till maturity if you're doing it yourself?
I would say on average 2 or 3 hours to get the loan, maybe a little more, maybe 4 or 5 hours to get the loan going, right? To do everything, underwrite it, structure it, negotiate back and forth, all the rest of it, just time and thought and so on, 4 or 5 hours. And then to manage it, if you're efficient and you know what you're doing, an hour a month.
Okay. And how many hours if you have it done for your service, like a syndicator or private mortgage management firm?
0.
The time to read the email and say yes or no kind of thing.
But 0. But you need to build a relationship with that company. You have to feel comfortable trusting them, and they have to be making a difference, right? They have to be good at not only doing the job of administering a mortgage and have systems and procedures in place for handling all kinds of different types of occurrences, as rare as they all may be. You still have to be prepared for them all.
Yeah.
But in addition to that, you also need competency, and you need people who are going to communicate to you. They're your administrator, so they are to report to you on what's happening with your investments. Most times, nothing's happening. It's boring as it gets, and you're getting your payment every month. There's nothing to report. There's no monthly statement required because it's the same as last month.
Yeah.
Right. So it's very boring that way. But as soon as something is irregular, you should be getting reported to. It's funny. I received an email a couple days ago from an investor who just had a question about a mortgage that is in default, and we're just waiting to sell it. And she mentioned in her email that there's 2 mortgages in her portfolio that have some issue. Now, one is in default. The other just got extended for a few months. But I took from that, I could feel in the email that there was some level of discomfort, likely because one is in default, right? Which no matter how safe it is, how big the buffer it is, when it's in default, there's a certain level of anxiety, I'm sure, for people. They worry a little bit. They love us, they trust us, all the rest of it, but still. So anyways, I sensed this from the email. So I wrote her back and I just said, listen, here's a link to my calendar. Why don't we jump on a quick call and let's go over the 2 mortgages in question so you get the most up-to-date information. I can tell you exactly what's going on with both. I think you'll sleep better at night. So she booked the call, but she sent an email back to me saying, this is exactly what I love about Magnetic. She said, I work with other brokerages and whatnot where getting information is like pulling teeth. And in your case, I write you a simple email just expressing a question, and you invite me to a conversation. And this is very important, inviting people to a conversation. The things that we're doing, the community, these are all invitations to a conversation. The Tuesday night founders table where anybody can join and ask questions. And so that's how you take a good thing and bring it to them, serve it to them. Yes, we can bring services. We can do everything for you, cross T's, dot I's, make sure it's done well, and so on. But the communication piece is so important, right? Talking to people, educating people, answering questions, that kind of thing. The work is the easy part.
So that's if we were to like have the stressors on one side versus the other. So you've got I guess the most stressful thing that can happen are tenant issues on the landlord side.
Yeah. Yeah.
Worst case, maybe tenants causing some damage or being difficult or not paying,
Yeah, I
refusing
would
to
say.
leave.
Yeah.
And on the private lending side,
Default.
Yeah.
Yeah, default. And now I would say the default process or the power of sale process is more predictable and more linear than the landlord tenant side of things. But they're both a pain in the ass, and you try to avoid, situations as much as possible. In that way, they're the same, but different problems for sure. Still dealing with people, right? Bad tenant, bad borrower.
Yeah.
Reality is most are good.
Yeah, it's what's the default rate? 1 to 3?
Yeah, and it depends on how you define a default. Like in behind the scenes at Magnetic, we have 3 stages of default: default 1, default 2, and enforcement. And default 1 is you missed your payment or it's late by a day. So it's not,
Yeah, let's say liquidation of collateral. Let's just be
liquidation of
hyper-specific.
collateral is, I think 1% is high.
Yeah, okay. And that's, I guess, the highest stress situation.
Yeah, I mean, but at the same time, if you have a good enough buffer, if you act efficiently, you don't waste time, and the market doesn't absolutely capitulate, you should be good. If you got 25% equity in the property and you move through the process efficiently, right? And you protect yourself and you know the rules and you abide by them. Yeah, it shouldn't be too much stress.
Whereas on the landlord side, I have heard of tenants not paying for 6 months, eventually getting evicted, but then for whatever reason, not having to pay the 6 months.
Very hard to collect it.
Yeah, hard to collect it. That's crazy.
With us, it comes off the value of the sale of the property.
Yeah.
It all gets paid, unless there's a shortfall of some sort, and that would be caused by the value of the property dropping. But significantly, like in 12 months, you're talking 25%. On average, almost 30% for us.
And on the yield side,
Mhm.
like let's strip away appreciation because, let's just do it apples to apples for now. I mean, property values go up, they go down. And I assume that, you're in control of some of the appreciation. Like you can always do renovations and make your property go up in value, but let's strip that away. 6 to 11%, let's say, call it 8, 9. That seems like high
Exceptional.
yield
It's exceptional.
if you're a landlord. That doesn't seem like that's common in
Well,
terms of
look at
achieving
it.
that yield.
Look at it this way. If you have $1 million home and to make 9%, it would have to go up by $90,000 every year.
No, but say you're yielding 9% in rental income. So $1 million home. So so 90,000 a year, you'd have to rent that home for like 8,000. I don't think $1 million homes are getting 8,000 in rental income. Like we're not even talking about expenses yet, just like cash
That's
on
right.
cash.
But you're getting rent and then you're getting appreciation. I'm just saying to make the 9% in appreciation would see the property go up quite a bit, which we've seen runs where it does go up, but it doesn't always. So, listen, when you're getting yields of 8, 9, and you can get it every single year, it's tough to beat long term. It's tough to beat.
Paid out every month as well, just like being a landlord.
Just ask. Just ask every person you know one question. Next family gathering you're at, next social gathering you're at, whatever. Just ask them all. Listen, you don't have to tell me what you invest in. I don't want to know what you earned. I don't want, just tell me the answer to one question. Over the last 5 years, do you think you have averaged taking home 8% a year? 8% after everything. 8%. If the answer is anything but, yeah, if it's yes, you'll know it. Those people will know. Right? And they won't hesitate. They'll be like, yep, I sure am. And your response to them is keep doing what you're doing.
Yeah.
But if the answer is no, or maybe, or a hum and a haw, and you're not sure, and
Oftentimes I
probably,
find that it's more like, oh, this is a long game kind of play. I'm building equity. All I know is my goal is to pay it off eventually, and that's my nest egg when the day comes.
yeah. So did you make 8% per year? If the answer is no, you should take a hard look at private mortgages because there's no shortage of borrowers and the yield isn't going to change. You're still going to get good, even in a low interest rate environment, you're still going to get your 8. Worst case 6. And you're going to love a 6% mortgage, 65% of the value, first position. How do you lose? Property's going to lose 35% in 1 year. That would break you even.
Yeah.
So
Yeah, no, for me, like I'm not a handy,
love all the
Gotta-
landlords out there, but if it's giving you a headache, come over to private lending, take a look, think about it. Might work for you.
Yep, have a look.
All right,
That's it.
episode 4, all done.
All right, bye everyone.
Yeah.